Want to welcome everyone to the revenue recognition. We're going to cover the new guidelines that FASB came up with, and they worked about 10 years with the IFRS to come up with these guidelines so that they're really in compliance with each other. We have a 5-step approach for revenue recognition model. Step 1 is identify the contract. First thing you have to do is there a contract? Does it exist? And it can be written, verbal, or implied. Step 2 is identify the performance obligation or obligations. You can have multiple obligations in the same contract. Step 3 is determine the transaction price. Step 4 is allocate the transaction price to performance obligations. If you have multiple performance obligations, then you have to allocate the price that you have to each obligation. And step 5, recognize revenue when the performance obligation is satisfied. Okay. Recognize contract if the following are met. Agreed upon by both parties. Identify each party's rights regarding the goods and services to be transferred. Identify the payment terms. Doesn't have to be a fixed price necessarily. You can have volume discounts in there and rebates. It has commercial substance, so is both parties going to benefit from the contract, and is it collectible? Okay. Some of the issues we may have. If you have termination rights, do not recognize revenue if either party can terminate the contract before the performance obligations or without penalty. Revenue is recognized when it's completed. So if either party can cancel the contract before the performance without penalty, you recognize revenue, and of course your answer is no. Okay. Next issue we have is combining contracts. Counts as one contract if a company enters into several contracts with the same customer at or near the same time. Now that's not a hard fast, it has to meet these two criteria, or has to meet one of the following criteria, I should say. Company negotiates the contract as a package with a single commercial objective. The amount of one contract is dependent upon the price and performance of another contract, or all or some of the goods promised in the contract comprise a single performance obligations. Keep in mind, the key here, it only has to meet one of the following. So we can even highlight that if you wanted to. Okay, that's all it has to meet. Okay, contract modifications have to be agreed on by both parties. It may create a separate contract if the modifications of goods or services are distinct and separable from other goods. Price of the contract increases by an amount that reflects the standalone price. Now, on this one, it has to meet both of these criteria. So the first example we have is on January 15th, Connie Printers entered into a contract to sell 750 custom printed shirts for $11,250 or $15 a shirt. Connie is expected to deliver the shirts in July and August before the start of the school year. On August 1st, 2019, after 500 shirts were delivered, Beth ordered an additional 150 shirts at $20 a shirt, which was the market price. So in this case, remember, modification adds goods or services that are distinct. Well, they are distinct because there's 150 different shirts that we ordered, and it's at market price. So that means that we have actually two contracts. So for the first 500, we have cash equal to 500 times the $15, and sales revenue is also 7,500. That's for the July. A cash I put in there, it could also be accounts receivable, which more likely it would be. We have cash is equal to, we still had 250 at 15, which is 3,750. And of course, sales revenue would be also 3,750. Then for the other 150 shirts, like I said, it could be, I'm putting cash in there, but it can be accounts receivable, equal to 150 times, that was at the $20 a shirt, or 3,000. Sales revenue would also be 3,000. So this is handled as two separate contracts because the additional shirts are distinct, and it was at market price, and the delivery date was also specified. So everybody's happy with that one. Okay. What happens if we do this though? On January 15th, Connie Printers enters into a contract for the 750 shirts with Beth School for $11,250 again. Connie's expected to deliver the shirts in July and August, just as before. On August 1st, though, after 500 shirts were delivered, Beth and Connie Printing agreed to increase the order to 900 shirts, which is an additional 150 shirts at $750 additional cost, or $5 per shirt. Okay, this is not, it does make the distinct part, the first part is distinct. The shirts are different from the original shirts, but the contract price is below the market price. So therefore, it's not a new contract. It's a modification of the contract. So the original cost that we have here, we're supposed to receive 250 times 15. The new portion of it is times the 5, or 750, which is what it says above. We add those together, so our total that we get is $4,500. So we have equal the 4,500 divided by 400 that we have left to deliver. So it's $11.25 per shirt is what we would recognize. So as we deliver the shirts, we deliver all 400 of them. It would be cash for 400 times 11.25, and sales revenue. Now I use cash, like I said, but it could be accounts receivable, just like we did before, for $4,500. Okay, this is the prospectus approach. We change the value of what we have left to modify. We modify the value that we have left. So it's $11.25 a shirt instead of $15 a shirt. The other method we have is the catch-up method. On this one, we do the same thing. They ordered 750 shirts at $15 a shirt to Beth School again, and delivered the times the same, July and August. This time they added, after 500 shirts were delivered, we're going to reduce the price of the remaining shirts to $10.50. Okay, so we didn't order additional shirts on this one. We decided to, both parties agreed to reduce the price of the shirts to $10.50. So the entry for the first one is going to be cash or accounts receivable. Again, it's for the $7,500 because that's the 500 times the 15. Sales revenue will also be the $7,500, just like we did before. Okay, so due to the agreement, we need to reduce the amount of the original contract. Okay, so we have equal 500 times the 15, so we've done the 7,500 like we did above. The new price is $250 times 1050. That's for the new one. Okay, for a total of $10,125. So to get the new price on this 750, we have equal 10,125 divided by 750. Okay, so notice we did not order new shirts. We just reduced the price on the remaining 250 shirts. Okay. So what we should have recorded is $13.50, and we'll put an equal sign in front of there so it multiplies, or $67.50. We recognize 7,500. So what we want here is how much is the difference. So we have 7,500 minus the 67.50, or $750. So it's overstated, so we debit the sales revenue account. For the 750, and we credit unearned revenue for 750. Don't give them the money back, just because they're going to buy more, so it's 750. Okay. When you deliver the shirts, unearned revenue will be for the 750. Cash or accounts receivable will be for the 250 times the price of 1050, or 26.25, and sales revenue will be a credit for the 33.75. which is these two added up. Okay, so that's how you do the catch-up method. Okay, on the next one we have, let me get to that page. Okay, performance obligations is what we're going to cover next. Goods and services are distinct if all the goods and services are sold separately, and are the goods and services distinct in the contract. Okay, for example, a contract enters into a contractor. It should be a contractor, not a contract. Enters into a contract to complete a building for a client. The contractor provides plumbing, electrical, and drywall installations. Even though these services are standalone services, the contractor has one performance obligation, which is the completion of the building. If he had entered into separate contracts for plumbing, electrical, and drywall, it would still be the completion of the building is what it's for. Okay. If he just entered into the plumbing contract and then maybe a week later entered into the, hey, we want you to do drywall, then you'd have distinct contracts after it was performed. Okay. Upfront payments. Payments received before goods or services are delivered. Non-refundable, such as setup fees, activation fees, membership fees, you have them all the time. So we have the W requires a non-refundable membership fee of $120 to join the gym, and a monthly fee of $25 to join the gym. It's a one-year contract. So you pay $120 for the membership fee up front, and then you pay $25 a month after that. And it's 1 year. So what we have on this one is cash of, well, it's equal to the 120 plus the 25 times the 12, or $420. I'm assuming they pay it off up front. And then you have unearned revenue because they haven't done anything yet to earn it, and that will be for $420. Every month then, you have debit unearned revenue for the 420 divided by 12, or $35, and sales revenue is a credit for $35. Okay, those are upfront payments. Variable considerations. What we have on this one, I'm going to save.